Hi, this is Stuart Weems and welcome to the Investopoly podcast. My goal is to give you simple, easy to understand strategies, insights and tips to help you master the game of building wealth. And in this episode, I'd like to talk about quantitative easing, something you might see or hear about in the media. And I thought it'd be good to sort of unpack it a little bit and explain what it is and whether as investors we should be worried about the impacts of quantitative easing. So let's first frame the situation. Essentially, a ratings agency, a global rating agency called Fitch, estimates the total value of quantitative easing during this year could reach 9 trillion Australian dollars. So to put that in context, that is nearly half the amount of total global quantitative easing that occurred between year 2009 and 2018. The Federal Reserve in the US alone has pumped $4 trillion into the market over the last 11 weeks. And so it's an absolutely unprecedented level of quantitative easing. And it's bound to have impacts on market and investment prices and liquidity and these sorts of things. And is it something that we should be concerned about as long-term investors, and if so, what should we do about it? So let's start with a bit of background of what is it, and in fact, let's talk about what central banks do. So the role of central banks around the world, including the Reserve Bank of Australia, RBA, they're in charge of monetary policy. And the aim of monetary policy is to ensure you've got a healthy economy and that the inflation rate is within a stated goal. The government will normally dictate what that goal is. In Australia, the band is between 2 and 3%. That's where they want inflation. When the economic activity increases and the economy approaches full capacity, that's when inflation can begin to arise. And in that situation, a central bank would normally increase interest rates. And because if we increase interest rates, it means you and I have less money to spend, but also corporate profits are lower. And that tends to cool economic activity. Of course, when the economy slows down, what the central bank will do is tend to cut rates, and that will increase corporate profits and increase consumer spending typically. And interest rates are really a central bank's primary tool for managing monetary policy. But when interest rates go to zero or close to it, of course, that no longer becomes an effective tool. Of course, you can go negative interest rates. Some fixed rate loans in Germany recently are negative 0.04%, which means you can go and borrow $100 and you don't have to repay the full $100 when the term finishes. But negative interest rates are relatively ineffectual in terms of their monetary policy impact. And certainly in Australia, the Governor of Reserve Bank, Governor Lowe, has said no negative interest rates in Australia, which I think is probably the right thing. So what is quantitative easing? Well, when interest rates stop being effective monetary policy tools, central banks have to start considering more unconventional mechanisms. And quantitative easing is really the process of the central bank buying investment assets such as bonds. And they do that by issuing new currency, that is often referred to as printing money. So they create or increase the supply of currency. And essentially what it aims to do is stimulate the economy by injecting cash into the economy. So let's have a look back in 2009 when we were in the middle of the GFC. What the US Federal Reserve started to do, which is the US Central Bank, it started buying what's called mortgage-backed securities. And essentially what that means is that a bank could come and sell a mortgage-backed security to the Federal Reserve and say, okay, I'm going to sell you this bond for $200 million. I'm going to pay you 0.2%, for example, so very low interest rate. That means the bank now has $200 million it can go lend to home buyers and investors and so forth. And it was a way of pumping money into the banking system to get banks lending into residential sector to try and stimulate that sector and help property prices recover. And to a large degree, it worked really well, and it actually achieved its aim. But quantitative easing isn't limited to mortgage-backed securities. Central banks can buy any assets, so including corporate bonds if they want to get money out into the corporate sector, and even Bank of Japan has bought equities to try and, again, stimulate capital in markets. Central banks can target certain areas as well, and most recently they've been targeting the SME sector. So let's look at what's happened this year. Well, everyone's jumped on the bandwagon this year in terms of central banks. And the RBA's participated, the US Fed Reserve, Bank of England, European Central Bank, Bank of Japan, and I'm sure there's other banks around the world, central banks around the world in developed markets that have participated in quantitative easing programs. But they've been much wider and significantly deeper than they were previously. So certainly a lot of liquidity has been pumped into the markets. And the aim has really been around buying corporate bonds, and the aim is to increase lending into the small to medium enterprise sector in particular. And the US Federal Reserve has been buying exchange-traded funds as well that invest in corporate bonds, and some of those ETF products they've been investing in invest in non-investment grade corporate bonds, or what's often called junk bonds. And so really, which is bizarre, because you normally wouldn't see a central bank invest in any higher risk assets. But it seems like in the US they're not that too perturbed about what they're investing in. And as I said at the beginning of the podcast, Fitch reckons it's going to the level of quantitative easing will approach 9 trillion Australian dollars this year, which is again a ridiculous amount of money printing essentially. The RBA has participated too. It's been providing very low cost of funds to banks for a 3-year fixed rate of 0.25%. And the idea of that is to fund the banks so that they can support the corporate sector as we get through the lockdown, and also obviously homeowners switching to really low 3-year fixed rates has been a way of sort of helping people through the coronavirus turmoil. So what is the impact? What is the longer term impact of QE? Well, there's been a study by Wharton Business School, a quite deep study. Now we have nearly a decade's worth of data. And essentially the key finding is that what it can do is crowd out certain types of lending. So certainly during the GFC in the US, the Fed Reserve was buying a lot of mortgage-backed securities. And so most of the banks stopped lending, or at least reduced lending to a significant level to businesses and corporates, and really just focused on the housing sector. And that can be problematic because, the housing sector doesn't generate economic activity per se, not like it does in the business sector. And also that can lead to price bubbles as well. That was the main findings of that quite deep study. There's two main criticisms, however, of QE, or possible criticisms. The first one is that the bank is interfering in a free market, and that could artificially influence prices of investments. In a free market, the market participants set the prices of investments. And if there's no buyers for a particular investment, well, there's no buyers. That means that investment is arguably, at that point in time, worth nothing. And that's how a free market works. When COVID hit, for example, no one wanted to buy bonds, even seemingly very safe investment-grade bonds, and this created a liquidity crunch. So investors weren't able to sell their bonds. They now had an investment that was essentially illiquid. And for issuers that needed to renegotiate or roll over facilities, that wasn't available to them either. And that if that liquidity crunch had persisted for a longer period of time, that could have really exacerbated the impacts of the COVID lockdown, and that's why central banks jumped in to intervene. But really they're intervening in a free market, and so free market supporters would say that such intervention creates artificial prices and alters investors' risk premiums, which means that, if investors start to think that everything is too big to fail, and if everything went bad, the government's going to jump in and bail them out, then investors start to become a little bit blind to risk, and asset bubbles can be created. So governments involving themselves in a free market activity isn't always a great thing. The second criticism of QE is that it can potentially cause inflation. So inflation occurs because the volume of printed money in circulation increases. And so, if there's $10, 10 $1 coins in Australia, and suddenly we double the amount, now there's $21 coins, potentially the value of that dollar then reduces. And when you go out and buy your loaf of bread, instead of costing $2, it now costs $3 because the value of that money has reduced, and therefore it creates that level of inflation. Except for the fact that really QE's been used or implemented since 2009, it really hasn't led to higher inflation at this point in time. And there could be a few reasons for that. Firstly, there are signs that there had been or has been a lot of money hoarding. So that is that individuals and corporations are saving money, so it's not actually going into the system. So then, therefore, liquidity or the volume of money in circulation hasn't increased, or at least increased as much. And secondly, wage inflation has been well below trend. And so maybe that has offset some of the impacts of QE. Very difficult to kind of isolate these things because whilst QE has changed, a lot has changed at the same time. So to try and isolate what is the impact of this this QE issue, very difficult to unpack. In terms of the future of monetary policy, well, it'd be very, very interesting, I think, to see what happens over the next few decades. And I think the big question is whether economies and markets will be able to support higher interest rates, and when that, if and when that occurs, and to what extent. For example, Japan's been stuck on near zero interest rates for about 25 years. So once you're on zero interest rates, certainly from a Japanese perspective, it can be difficult to get off them. If interest rates remain persistently low for a number of years, and I think they will, then quantitative easing is almost certainly likely to remain. The Fed Reserve did during 2018 and 19 start to wind down its balance sheet. That is, stop the amount of purchasing of assets and, in fact, try and pull a bit of that money out of circulation again, just to normalise their balance sheet. But every time they talk about doing that, the share market gets the jitters. So there's not a big appetite, really, across the board for central banks to sort of stop quantitative easing, or at least start winding back their balance sheets. And the same happened in Europe as well. They started talking about it, and no one really liked it. It's difficult to really assess, as I said, the impact of quantitative easing because so many things are moving around at the same time. Particularly, you've got COVID going on and trade wars and all these sorts of things. But to my mind, endlessly printing money and buying assets when investors desert the markets doesn't seem like a wise practice to me. And to me, it feels like, look, at some point, someone's going to have to pay the piper. There's got to be some implications of such behaviour. Of course, it could artificially inflate prices, particularly if people think that money is cheap, they don't need to be as deliberate with their investment decisions, that if everything went wrong, the government's there. And maybe if we look to the share market, we look at listed entities like Tesla, the car manufacturer Tesla. It's worth circa 230 billion Australian dollars at the moment. That's twice the value of CBA. It's never recorded a profit. Its debt's increased by 5 times over the past 5 years. And its net assets are worth less than 10 billion Australian dollars. So how could it be worth $230 billion? And maybe that's where all the risk lies. In those sorts of businesses, those sorts of sectors, we see it in IT as well, in tech, some of the high valuations. Someone like Apple, for example, very fundamentally sound, strong profit, strong cash flow, strong balance sheet, lower PE, no problem. But when you compare that to a Netflix, Netflix, there's no rational valuation metrics there. One of the touted reactions to quantitative easing is to invest in gold, because the thesis is that quantitative easing will eventually lead to inflation. And so gold is a natural hedge to inflation, because you've got that hard currency asset, physical asset, I should say, that's going to be protected from devaluing currencies. But with gold at nearly all-time highs, that doesn't really seem like a good investment. And QE hasn't caused inflationary pressure over the last decade, and I don't think it's likely to do so. If it does, then central banks can just increase interest rates anyway. We're coming off a very low base, zero base almost, so that's not out of the realms of possibility to try and curtail inflation. I think overall, our best response to QE is to avoid overvalued markets, sectors and companies that are trading at unjustifiably high valuation multiples. For example, during the dot-com bubble or the tech wreck, Warren Buffett didn't participate in any tech investments at that stage. It was very well documented that he was saying that tech valuations didn't make a hell of a lot of sense to him, just like Tesla's valuation at the moment doesn't make a hell of a lot of sense to me. And as such, he avoided any tech investments, which proved, given the dot-com bubble in the early 2000s, proved to be a very wise decision. So I think we can leave on one fundamentally sound statement. That is that your starting valuation in the share market is perhaps the best indicator of future expected returns, so long as your investment methodology is sound and robust. So if you invest when markets are at their peak or at highs, at very high valuations, you probably can't expect very good future returns. If you invest when a market looks very, very cheap, then there's a very high probability of you enjoying above mean returns in the medium to longer term. And I think that's the best way to deal with any potential impacts of QE, which are probably largely unknown or unascertainable at this particular point in time. Okay, a bit of a technical one this week, but I hope it's been of interest. And if you see quantitative easing being talked about from now on, at least you know what they're talking about. It make a little bit more sense. Okay, until next week, bye for now.